Welcome back to the 5 p.m. podcast. I'm Tina, your host for all things.
And I'm Dan. I usually get excited about the technical side of things.
That's an understatement. But hey, that's why we're a good team, right? So episode 19, can you believe it?
Time flies when you're having fun. So today, we're diving into something that's been making waves in the financial world. The Silicon Valley Bank situation.
Oh yeah, the bank that catered to all those tech startups. I've seen so much chatter about this online. It's a big deal, right?
It's a huge deal. So basically what's happening is, the Federal Reserve's own watchdog, their internal review team, they're saying the way the Fed supervised Silicon Valley Bank before it collapsed wasn't up to par.
Okay, wait, let me get this straight. The bank collapsed, and now they're saying the oversight was lacking? Is that the gist?
Exactly. The report from the Inspector General, that's the watchdog, it basically says the supervision didn't keep up with how fast the bank was growing and how complex it was getting.
So SVB was growing, getting more complicated, and the regulators, what, couldn't keep up?
That's what it sounds like. The report mentions multiple instances where they should have acted sooner or taken stronger action. I was just reading about this and it's kind of concerning, to say the least.
That's putting it mildly. So what were they supposed to do, in your opinion?
Well, they have these ratings, the CAMELS ratings. It is a way of scoring how healthy a bank is, and it stands for capital adequacy, asset quality, management, earnings, liquidity, and sensitivity to market risk. Each component is rated on a scale of 1 to 5. It seems like they should have downgraded SVB's ratings sooner, which would have triggered more scrutiny.
Sounds like a report card for banks. And SVB wasn't getting good grades?
Apparently not. And here's the thing about SVB. They had a ton of uninsured deposits. We're talking about deposits over the FDIC insurance limit, which is $250,000.
Oh, right. The magic number. So anything over that? And you're not covered if the bank goes under?
Right. And SVB had lots of big depositors, tech companies, venture capital firms, with way more than $250,000 in their accounts.
So when people started getting nervous about the bank, what happened? Did they all try to pull their money out at once?
That's exactly what happened. It's called a bank run. The report says over $42 billion with a B was withdrawn in a single day.
$42 billion. I can't even picture that much money.
It's an enormous amount. And it basically crippled the bank. They couldn't handle that many withdrawals.
So what's the takeaway here? Should people be worried about their money in other banks?
Well, it's a good reminder to understand how deposit insurance works, and maybe not put all your eggs in one basket, especially if you have over $250,000.
Makes sense. Diversify, as they say in the investment world.
Right. But there's another layer to this whole thing. The former CEO of SVB, he was on the board of the San Francisco Federal Reserve.
Hold up. The CEO of the bank was on the board of the organization that's supposed to be regulating it? Isn't that a conflict of interest?
That's what a lot of people are saying. Senator Bernie Sanders, he was very vocal about this. He said it would shock most Americans to find that out.
I can see why. It's like the fox guarding the henhouse, right?
Exactly. It raises questions about how independent the regulators can be when they have such close ties to the banks they're supposed to be overseeing.
So what's being done about this? Are they changing any rules?
There are definitely calls for reform. Some people are saying that bank executives shouldn't be allowed to serve on the boards of regional Federal Reserve banks.
Seems like a reasonable suggestion to me. You want the regulators to be impartial, right?
Agreed. And it looks like they're going to be looking more closely at mid-sized banks in general. Banks that are bigger than your local community bank, but not as big as, say, JP Morgan Chase.
So, more scrutiny for banks that are in that Goldilocks zone? Not too small, not too big?
Yeah, that's a good way to put it. And they might change some of the rules around deposit insurance, too.
This whole SVB thing, it's like a wake-up call for the banking industry, isn't it?
It really is. And it is a reminder how important it is to have effective oversight, to protect depositors and keep the financial system stable.
So true. You don't want to have a financial crisis, which I've heard this almost caused.
I mean, the fact that SVB is the third largest bank failure since 2008 shows that this was a big deal.
Well, thanks for breaking it down for us, Dan. You always make these complex topics so much easier to understand.
Hey, that's what I'm here for. And thanks for keeping me in check, Tina. We make a good team.
We do. All right, folks, that's all the time we have for today. Join us next time on the 5 p.m. podcast, where we'll be tackling another big issue. And probably geeking out a little, too.
See you then.